Welcome to the Bogart Effect, a wealthy wisdom podcast. The following Bogart Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the Bogart Effect. We have a very special visitor today, Troy O'Callahan. So Troy's been our tax partner. How long have I known you, Troy? Probably 10 years or so. I mean, it's been a good bit.
Yeah, going on 10.
But you've been doing helping clients of ours for a long time with doing their tax returns. You know, and this is an interesting topic today because we specifically want to talk about tax-related questions and some of the common questions you get, we get, and just have a dialogue around it. So, you know, just to kick it off, probably the number one question I get, Troy, is should I take standard deduction or itemize? And I'd love to get your commentary here.
Well, like a lot of things in taxes, it depends. So just to give you an example, and this number changes every year, the standard deduction for a married couple is a little over $31,000. So every married couple is going to be able to take $31,000 off of their taxable income. And that's without doing anything. And for a single person, it's about half that. You're able to take your own deductions if you want, as long as that list is more than that $31,000 standard deduction. And that list includes stuff like medical expenses, property taxes, mortgage interest, charity. So if that list is greater than $31,000, you'll take that list. So what we're seeing is probably about 75% of people will take the standard because historically it's pretty high.
Well, and some of that's a byproduct of the original Trump tax bill back at the end of 2017, where they materially increased the standard deduction because the whole point was to simplify, not have as many people itemizing. And you know, kind of on the other side of it too, my understanding is they capped, state and local property tax exemptions. So it kind of more or less, if you didn't have a large mortgage interest or very charitably inclined or big medical expenses, you're going to standard, right? I mean,
yeah.
And I think, you know, with the one big beautiful bill announced, because I'm sure we're going to have questions associated, like kind of going forward, you know, the whole commentary is that they're dramatically increasing the caps, right? So 10,000 is going up to 40,000 on the state and local property tax for itemizing.
Right.
But there's a whole bunch of caveats to that and income phase outs where for a lot of people who are especially still working in higher income environments, you're most likely still going to have the 10K, you know, and or some combination between the two, right? And the reality of it is I'm going to come back to your comment of it depends. We need to have an analysis done of what is the right pathway. But to your point, at a minimum, you get the standard deduction, which is $31,500 for a married couple, right?
That's right.
So I guess that leads to kind of the next question that a lot of our clients ask is, how do I lower my taxes? I know that's like a very vague and nebulous question, but
that's right.
I'd love to hear some of your thoughts.
The quickest way is to adopt a couple kids.
Okay.
That's not a long-term financial plan, though. But what I would say is make sure the things that you're already doing, that you take credit for it. And so at the end of the year, make sure you get all your goodwill receipts, your cash contributions, your property taxes, and then stuff for things like daycare credits, tuition credits. So there's a lot of things that you are entitled to. You need to make sure you take those on your tax return. And then there's things that we call low-hanging fruit. And those are things like 401k contributions. If it makes sense for you, based on your financial situation, to max out your 401k, max out your HSA contributions. If you can make a deductible IRA contribution, that's going to help you save in taxes. And that just gets you started on things that you've already done or low-hanging fruit. And then you need to take a look at multiple years. And so there's some situations where if you know you have capital gains in future years, let's say from sale of a business or stocks that you're going to sell, you can start now to have losses that can offset those in the future. And then you get into something that we call deduction bunching, which, as you mentioned, the property tax deduction has grown for most people to $40,000. So this deduction bunching is going to come back around to make more sense for people. And let me explain what this is. This is for someone who is traditionally not itemizing, and they just don't have enough to go over the $31,500. And so what they will do, for example, property taxes. When you get your property taxes in December of 25, you wait until January 26 to pay that. And then the December 26 property tax bill, you pay in 26 as well. So remember that you get to take a deduction for whenever you pay these tax bills, not from what year they apply to. So in that year, you're going to be able to double up on your property tax deduction. And the next year, you'll take the standard. So that's a little bit more complex. You have to take a look at that over several years. You can also do that with charity, but that's probably beyond the scope of this conversation.
I know. I was actually, my mind immediately went to that. Like, especially if you're going to use donor advised funds, right? You could do a larger charitable gift in 1 year, very similar to what you're describing with paying the 2 sets of property taxes.
Yeah.
And you could move money into a DAF, donor advised fund, where you're then able to get the larger deduction in that 1 year. And then it allows you to then go to standard the next year if that's something that you want to do.
Right.
Real quickly, I just wanted to describe for our viewers a couple of the things that you mentioned. 401ks and IRAs are retirement accounts. Different types. So 401k is an employer-based retirement account. I love maxing that out. This is the financial planner in me. I'm going to want you to save every dollar you make, leave nothing left to live off of. I'm also going to want you to live to 80 and die at 81. Those are terrible jokes I use, but there's a lot of application in there. The more you save, the better off you are. An IRA is an individual retirement account. So it's another one where we can save outside of employer-related plans. And a lot of times we're using them for spouses that may or may not be working as well, just as another way of saving. And then the other one you mentioned is HSAs, which are health savings accounts that are dedicated savings accounts, allow for tax deductions, but then it's monies that are available to use on a tax-free basis to be able to use for medical expenses. So perfect segue to my next question, though, Troy. What can I deduct medical expenses?
Well, again, it depends. So let me explain the rule here. The IRS says you can deduct medical expenses as long as they're over 7.5% of your adjusted gross income. Now, for most people, adjusted gross income is just their total income. So if you imagine me or you making wages of $100,000, or someone who's retired who takes a IRA distribution of $100,000, that is their AGI, their adjusted gross income. If you take 7.5% of that, that's $7,500. You have to have more than $7,500 in medical expenses before you can start to deduct them. So, for example, if you had $10,000 of medical expenses, that's $2,500 over the $7,500 hurdle. You'd only be able to deduct $2,500. And keep in mind, you have to add that to your property tax, mortgage interest, and charity. And if that's over $31,500 for a couple, then you get to deduct it. You take your itemized deductions, and that's when medical really counts. If after you add all that up, it's under $31,500, you will not itemize. You'll take the standard. And so in that case, you're not really deducting your medical expenses.
Yeah. So question then, just to make sure I'm understanding clearly, the only way to deduct medical expenses is if you itemize, correct?
Yeah.
You can't take standard and also deduct medical.
That's correct.
Yeah. Okay. Yeah, I get that one a lot, and especially where you're younger and you have you're still in building that income, but of course that's usually when you're having babies and things of the sort, and medical expenses are pretty high, but you might not have some of the other itemized deductions in order to be able to get over that cap, right? So helpful conversation. So the next question that we get a lot is, what's better, a tax credit or a tax deduction?
All right. So credits are always better. Let me explain why. So a deduction will offset your taxable income. A credit will offset your actual tax bill. So here's an example. Again, if I have $100,000 in income, I would be in the 22% tax bracket. If I got another deduction of $1,000, I'd have to apply that against my tax bracket at 22%. That would save me $220.
So it would take your 100 down to 99.
It would take my $100,000 of taxable income down to $99,000 in taxable income. You're right. Yep. It would save me $220. If instead I got a credit of $1,000, that would save me $1,000 of taxes. So you can see there, that's saving me $1,000 versus a deduction that would save me $220.
Yeah, perfect. What is the best way for our clients to stay up to date on tax law changes?
That's very challenging. And you probably saw with this one big, beautiful bill.
That's a great name.
There were lots of changes to the bills as they were being debated. And as one,
Sure.
The House passed it or the Senate passed it and they hadn't passed a final bill. There are things that were in those bills that did not survive. And so if you kept track of it, you might be confused about what actually happened. And then there's also a bit of spin that the media has and the politicians have about different components as they try to sell this bill to America. But if you want really good resources, what I would do is the IRS has two. Surprisingly, they have two different resources. One they call the newsroom, and that's where you're going to see tax law changes, some fact sheets that summarize things. You can also get on their email subscription if you want emails from the IRS. And then beyond that, I would just go to good sources like Bloomberg, Reuters, Wall Street Journal. I will warn you about reading the actual bills because I tried. This bill modifies an existing bill. And so when you read the bill, it will say, strike this word from the original and replace it with this word. So you don't get the meat of the bill in that revision. You'd actually have to go piece maybe a couple bills together, and it just takes a long time to do it. It's confusing.
Well, and said another way, I think some of it's still subject to interpretation, and I'm sure we're going to see private letter rulings on a couple of the nuances of the One Big Beautiful Bill. We've already seen letter rulings on interpretation for the IRS as well. So more to come, I guess.
Absolutely.
But most of my understanding correctly is the most of the One Big Beautiful Bill, the meatier things don't go into effect until next year. Is that correct?
That's correct.
So we have some clarity for the rest of this year, but a lot of what we're looking at is 2026 stuff.
Correct.
And even still, I would comment, almost all of it has phase outs. So it's either an income phase out or a date phase out.
That's right.
So it's like, all right, well, we're probably going to have more conversation about this in a couple years. So let's talk a little bit about record keeping. This is another one that we get a lot of clients that are asking us about. Do you have any recommendations with regards to not only records, I think, that you need to maintain to prepare your annual tax returns, but even how long you should keep your tax returns and records associated with them?
Yeah, I'm a little biased. I think you should keep your tax returns themselves forever. If you have a way to digitize them, that's the best. But let's talk about the reason people keep tax returns. One is because they're afraid of getting an audit. The other is practical because they have some good information you might need later on. And so if you get to audits, generally speaking, the IRS can audit you up to 3 years past the day you file your return or the day it was due, whichever's later. And so the 3-year, that window is out there. I would definitely keep everything for 3 years. And that includes W-2s, 1099s, if you have a business, the business records. But if there's something, especially criminal or underreported on one of those returns in the past, the IRS can go back 7 years. And so I would really suggest keep everything for 7 years. But if you like to shred, I would do it after 7 years and just shred the W-2s, 1099, all the supporting documents. But I would definitely keep that tax return. We've had to go back to tax returns to find stuff like when you bought a house, when you sold a house, when you started to rent a house. And sometimes that's the only place that's documented.
Is the return itself or is the supporting documents?
Usually the return itself.
Okay.
Yeah.
Good to know. Yeah, I have this. I was so old school where I would have everything printed out and I'd have, the folders and now I'm traveling so much that I don't have access to those things usually. So I've had to digitize basically everything.
Yeah.
And there's secure vaults that I personally use, and then even a lot of our clients are using to just maintain tax returns and keep historical records to have access wherever you are or be able to share with trusted advisors like us to help with any type of planning work that we need to do.
Yeah.
So leads to the perfect question. I think this is probably also a biased one. Let's talk a little bit about tax software versus accountants. What do you think? If I'm leading the witness here.
You may be surprised how many times I try to convince someone to continue to do their taxes using TurboTax or TaxCut. Okay.
Why?
The software is pretty good. If someone is on top of their financial and tax affairs, they can input the information the right way and they'll get the right output. So I think it's best if you have a few sources of income and it's relatively not complex. Once you have a business or something more complex, that's when we get to see where TurboTax or TaxCut or some of the other ones wasn't really able to ask the right questions and you don't get the right results. And so I'll give you some examples. Things around stock options, restricted stock, especially basis issues when it's not reported on a 1099-B. Those can really throw off the tax calculations. And the errors that we see are the tens of thousands of taxes, extra taxes that someone might pay that they really shouldn't have if they'd done everything correctly. So it's good if it's a relatively simple situation. The other thing that we can provide or a tax preparer can provide is more strategy, especially multi-year strategy, which is something that the tax software just doesn't even try to do.
No, I would say that the value of any professional services person is around the strategy, not necessarily the direct implementation. Same with us, right? I mean, and that's exactly why we have our partnership with you. It's to me, the real value is not fixing my problem now. It's anticipating what my problems are going to be in the future. And a lot of them are driven by tax. I wanted to pull on that comment you made about restricted stock. That's hands down, in my opinion, there's two very large mistakes that I find with the tax software. Restricted stock and not putting cost basis in. So then all of a sudden clients getting a huge tax bill when they sell these shares that the cost basis had never been put in on. And then the other one is around backdoor Roth conversions. The tax software has the hardest time with this. And then that becomes like the huge frustration with our clients and a backdoor Roth conversion is where we do a contribution on an after-tax basis into a traditional IRA, establishing basis into that IRA, and then we immediately convert it to a Roth. So it's a tax-free transaction as long as there's no other balances in an IRA. But this is a fantastic example where tax software can make that the most frustrating transaction ever.
Yeah. So to that point, if we have a new client, one of the first places we look is the 8606 to see if they got taxed on $7,000 of a withdrawal, because it was done incorrectly.
Which almost every client that I've inherited or we've brought onto the firm after they've been working with someone else for previous, that is almost guaranteed to be a mistake that's happened. Or they've done a backdoor conversion when they shouldn't have because they have an IRA somewhere else.
Right.
That's another one I've seen that, and again, that's not the type of thing that tax software is going to pick up, but I know you and your team absolutely do every time we start those engagements.
Right.
So if someone's thinking about hiring an accountant, what are the questions that they should be asking?
Well, there's two certifications out there. There's an enrolled agent and there's a CPA, a certified public accountant. So I would try to choose one of those. And you need to ask if they are credentialed and then if they're in good standing with their board.
Sorry. So what's the difference between an enrolled agent and a CPA from a background perspective?
So it differs by state on CPA, how many years of education, but it's either 4 or 5 years. They've recently changed it. And then there's a experience requirement. There's also a pretty difficult test. The EA, the enrolled agent, that is basically a test, and it's just focused on taxes. The CPA exam is focused on a lot more taxes, accounting, GAAP reporting, ethics. There's other different categories. EA is really specifically for taxes. The CPA is a broader designation.
Is it safe to ask this, that if I just want somebody to prepare my taxes and not give me any of the strategy or planning, I'm okay with an EA if I'm relatively not complex? Or is it really the case I want a CPA?
Yes. So it's just like any other profession. I've seen really good CPAs and really bad CPAs.
Yeah, fair.
Same thing with enrolled agents. I know some really good enrolled agents. So I think if that's what you're looking for, tax preparation, that's great. If it's an enrolled agent that works in a CPA firm, they're probably involved in all aspects of what that CPA firm does.
All right. My next favorite topic: what happens? You get audited, and what should you prepare for if that were to be the case?
Okay. When we get an audit letter for a client, we don't get stressed out about it. Okay.
And sorry, this is IRS audits, correct? Not state, because some of us are fortunate enough to have jurisdiction or tax reporting in other states.
Yeah. We're really worried about the federal government here. The IRS
Me too.
is a little bit more onerous when it comes to audits. The reason we don't get stressed out is because I think one good thing a tax accountant can do for you, a CPA can do for you, is just to make sure you don't have red flags on your return in the first place.
So what's a red flag?
So a good red flag would be something like business expenses that don't make sense. So for example, if you're a contractor and you have $30,000 in your mileage deduction, and all you do is commute to work, then that's probably a red flag. The IRS really doesn't like mileage, or they really like to audit it. Or the use of a personal vehicle, like depreciating a personal vehicle, that's a red flag. So anytime we put that on a return, we make sure everything is done correctly. And we have a lot of people that try to deduct their commute when it's not deductible, or meals and entertainment when it's not deductible. So that's how we make sure we don't get audits. But when we do get an audit letter, it's usually the IRS is trying to confirm a number on the return. And usually that's because maybe you got wages from a company that didn't report your W-2 to the IRS. And the IRS thinks something's wrong. Okay. Those are very easy. I had one client that got a full audit in the past 10 years, and they passed without a problem. And I think it was just a random audit.
Okay. Yeah. I guess this is maybe a speculative question, but I keep hearing about with all the cuts that are happening in the IRS that it's harder for them to even do audits. Is that an accurate statement, or are they just being more selective?
Yeah, I haven't seen this last cut. I don't really have any good data, but I'm not sure how they can keep up with the audit schedule that they wanted to. As you probably know, it expanded under the last administration, and under this one, it has shrunk again. And so I think what they're doing now is the net that they cast is just having to be a much smaller net for the employees that they have to handle the audit work. And most of the people that we deal with, they don't have any kind of audit red flags or risks on their returns.
Yeah. And that was kind of where my head was going with this. It's like, if you're not really doing, let's just say, aggressive tax maneuvers, you're probably not going to be on the radar for audits. From what I've noticed, and this is clients and colleagues, higher audit risk comes from really, like you said, business expenses, real estate related transactions, big 179 deductions, like things that are absolutely bringing your taxable income down in a meaningful way. Yeah. And of course, the IRS that's going to trigger them wanting to look at you. Doesn't mean you did anything wrong. It just means that they want to have a conversation. Right. That's how I've always interpreted it.
Right. And I will say that our clients do get stressed out about this. So I don't want to say that it's trivial, but once it gets to us, we can usually calm people down. It's usually just a matter of sending some documents to the IRS.
Oh, I'll speak personally. I've been audited now. It's just getting that letter. It elevates a lot of emotional response.
Yeah.
Sorry, I should say I've not had a federal audit. I've had state audits, but it's not fun. Even though you're doing everything right and above board, it's definitely one that evokes some emotion as you're going through that process.
Right,
and it's not always as quick as you would like it to be either.
Right.
All right. What are some of the kind of more interesting / difficult things that you've seen?
Usually the good stories that I can tell without giving away any information are the ones where I've got a potential client in my office who wants to do something illegal. and especially when they don't think it's there's a problem ethically at all. So I had one that wanted to know where they should record the illegal gambling machine revenue from their bar. I told them that I couldn't be their CPA anymore. And then I had one that was a contractor in the oil and gas field, and he built a deer stand, a very nice deer stand, on a piece of property that wasn't his. And that turned out to be, in their words, a kickback so that they could keep the contract. Again, couldn't keep them. But when it comes to difficult returns, I would say that the clients that we take and the work that we do, it has to be something that we're already competent in. And normally if we get something that's difficult, that means it's outside of our wheelhouse. And that's usually stuff that includes non-U.S. involvement, usually income or inherited property. And for something like that, we know some good resources that we refer them to.
Yeah, I mean, we've had our relationship together. We've had a couple of these where, like you mentioned, inherited real estate or assets in another country, and we needed to repatriate. Or we've had some that have moved out of the United States and are now residents in other countries. Yeah, no, and it certainly adds a layer of complexity to the planning work and even the annual administration work, but it's not impossible. And I would say you bring in strategic third parties. Troy, I really appreciate the time today. This was a very fruitful conversation, and I think everybody's going to benefit from the words of wisdom you're instilling on us.
All right.
So thanks for taking the time.
Thank you. Thanks for having me.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.
The tax partner featured in this podcast is part of a team of accountants and tax professionals associated with the accounting firm of Troy O'Callahan CPA. Employees of Troy O'Callahan CPA render accounting and tax services for Bogart Wealth pursuant to a written agreement. Troy O'Callahan CPA and Bogart Wealth are not affiliated in any other way and are not under common control. No client of Bogart Wealth is required to use Troy O'Callahan CPA for accounting or tax services, but if Bogart Wealth provides you with or agrees to provide you with accounting or tax services, you will receive services from Troy O'Callahan CPA. Service provider fee rates, in addition to investment advisory fee rates, may apply. Please contact Bogart Wealth for more information on tax preparation and return service. The use of any CPA firm is no guarantee of results or outcomes.